Hi, I'm Mal from the Money Study, bringing you another episode in the Ultimate PSS Education Series. This is number 29, and we're talking about calculating a net pension. If you are over age 60, calculating a net pension from your gross pension. But this example is the third in the series, and it's basically looking at a larger pension. So, and when I say a larger pension, I'm actually talking a pension over $118,750. But before I get into all the details, there's my disclaimer. Facts and figures, information only, not advice in today's session. Now, I do strongly suggest you watch episode 27, which is the one on the medium-sized pension, to get all the details on how it all works and how the worksheet is incorporated. This is just a follow-on from session 27 and 28, and effectively this is just to give you the different things that we can show you, all the different things that happen if your pension is indeed a very large one. So again, all we're doing here is we're assuming some numbers. So this person on page 4 of their statement finds they've got 3 different tax components with values of $289,000 for the tax-free, $450,000 roughly there for the taxable taxed, and $867,000 odd on taxable untaxed. So that's their 3 different tax components. And then on page 2, we look at their total defined benefit amount. And the defined benefit amount on page 2 shows $1,606,012, which just so happens obviously to be the sum of the 3 tax components. So they've got a lump of money of $1,606,012. They are the age of 60, looking to retire. They use the pension factor of 11 because they are 60, and this generates a gross pension of $146,001. Not a bad little problem to have. So they've got a gross pension of $146,000 a year. How do we then calculate the tax on this larger size pension? Well, first of all, as in the previous 2 examples, we need to find what is the untaxed component as a percentage of the overall balance of that defined benefit accrual component. So, yep, they've got an untaxed component of $867,247. Their defined benefit amount is $1,606,012. Therefore, to find the percentage, we literally just divide one by the other, and this person's untaxed component works out to be 54%. So 54% of this rather pleasant pension needs to be taxed. So they will take the $146,001 gross pension, they'll multiply it by 54%, and therefore the taxable income is now $78,841. So that's their taxable income, putting them into the 32.5 cents of the dollar tax bracket. So we go to a tax calculator. We're using the tax calculator here on the Money Smart website. We punch in the taxable income of $78,841, and it then tells us that we've got income tax payable of $16,090 and a Medicare there levy of $1,577. So we literally add those 2 amounts together to give us a total tax liability at this point of $17,667 is the tax liability. And as we saw in episode 27, of course, this person is 60, an offset is applied, and the offsets are subtracted. So we take a 10% of the taxable income, which was the $78,841 as a taxable income, the untaxed component. 10% of that is $7,884. So this is the start, this is the offset. But, this is the big but, this pension is a large pension. Its gross value is over this thing called the transfer balance cap. Now, I am going to do sessions specifically on this topic a little bit later on, but for this time being, at this point in time, just understand that your pension is over a cap of $118,750, which is basically where anything above 118,750, the offsets do not apply. Okay, so you've got a line in the sand that says if your pension, I'm talking about your gross pension here, if the gross pension is indeed in excess of 118,750, in excess of that amount, you don't get the offset. So in this particular case, the gross pension was 146,001. It's over the threshold of 118,750 by $27,251. It's over it by 27,000 odd. So if it's over by 27,000, we can't claim the offset. 10% of the 27,000 is indeed $2,725. So we can't claim that portion of the offset. So our offset, which was $7,884, is actually reduced by the amount that we can't claim as the offset, the $2,724. Therefore, the offset is reduced down to $5,159. So it's just gone down a little bit. But our tax payable, of course, is still the full salary, the full tax of 17,667 minus our new offset, which is now $5,159. Therefore, the tax payable minus the offset reduces the tax payable down to $12,508. So even on this big pension, we're still getting some pretty reasonable reductions in tax because of the offset. Our gross pension is 146,001, and our tax bill now is 12,508. So our gross pension minus the tax gives us our net pension of $133,493 a year, which if we divide it by 26 gives us our nice net fortnightly pension of $5,134 per fortnight. A nice sort of arrangement. I did have a couple that were basically going to be bringing in about $320,000 a year from their two net pensions from the PSS between the two of them, $320,000 a year, and it indeed was insufficient. They couldn't live on only $320,000 a year. I think I can. I think I could. Not bad. Anyway, look, there is another issue that if when we look at the portion of money that is over the cap, what they do here is they stack the actual tax components. So they take the tax-free and the taxable tax components first. Then they plonk the untaxed bit on top. Put it on top, meaning that anything, so let's imagine your tax-free taxable tax was 80,000, and then you had 50,000 of the untaxed. Well, it's that extra 50,000, the untaxed, that pushes you above the 118,750. And so generally speaking, it's always the untaxed bit that is exceeding. It's not one of the other components, the untaxed bit that has exceeded, hence we get the reduction in the offset. Now, in the case of very large pensions, where the tax-free taxable tax components, just those two components alone, exceed the 118,750, then what happens is the excess on that components, the excess of that is then basically taxed at normal marginal rates on half of that excess. So, if you had $130,000 of the tax-free taxable taxed, so you're over like about $12,000, that $12,000 would be like halved, and you're paying normal tax on about $6,000 or so. And because then your untaxed is put on top of all of that, there would be no offset at all because the whole lot of the untaxed is above the threshold. Now, if you're in these sort of situations, obviously, please, have a chat to someone who really understands how all this works, before you try and do it. And hopefully we've given enough guidance here to give you some working for you to do. But I would obviously suggest people on that sort of level really need to make sure that they've got it right before they do the jump to fill out their paperwork. Feel free to make a booking on our website there to come and see Ash and myself, and we're happy to help you along. Talk to you on future sessions.